Sarah Borkson-Keeter with NAREITsREIT.com, and welcome to Quick Study, a monthly review of REIT market developments. I'm joined by Brad Case, NAREIT's Senior Vice President for Research and Industry Information. So Brad, in 2015 we saw lots of ups and downs month to month, but putting it all together, how would you assess the year for REITs?
Well, you know, December was sort of a microcosm of the entire year. It was a good month for REITs. REIT investors saw their total returns up 1.2% on the month. That wasn't the best month of the year, but it was good, especially compared to almost all other assets that investors were, might have been invested in during December. And that was true for the year as well. REIT investors on the year gained just 2.3% on the year on average, which is not a good year by REIT standards, but was a much better year than almost any other asset. The S&P 500, for example, was up less than half of that. Small cap stocks were down very sharply on the year. Small cap value stocks were down 7.5%. For the year as a whole, which is striking because a lot of investors still have this idea that REITs are a lot like small cap value stocks, and certainly, thank goodness, in 2015 that was not true. So what we saw is it wasn't the best year for investors generally, it wasn't the best year for REIT investors in particular, but you were a lot better off if you were invested in REITs than if you were invested in almost any other asset in the markets.
And among the different REIT segments, which ones stood out the most?
Very strong performance for self-storage REITs and for residential REITs, apartment REITs, and manufactured housing REITs. Self-storage REITs saw total returns of more than 40% during 2015. And I think what you're looking at in that part of the industry is a continued process of the professionalization of that business, a business that really used to be dominated by mom and pop operators of self-storage facilities is more and more dominated by a professional organization, a professional operation that benefits consumers, and I think that is really what explains a lot of the self-storage sector's long-term strong performance. When you look at the manufactured home community portion of that REIT sector, you're seeing the same thing. You're seeing a professional operation introducing a manufactured home community that really meets the needs of its target demographic audience, and that results in very strong operational returns, and investors are recognizing that and seeing very strong financial returns as well. And you're seeing the same. Also saw very strong financial returns in the entire residential sector, up more than 17% on the year.
And then in December, the Fed raised interest rates. Has that calmed the waters for a bit? Put that question aside.
Very good question, because as you know, this had been something that the markets have been worried about for really several years, on and off, and certainly it dominated a lot of the thinking about investments during 2015. When that finally happened, that turned out to, that coincided with good returns for REITs. As I said, not the best returns on the year, but to the extent that investors had been concerned about the effect of an increase in target interest rates on REIT returns, that certainly wasn't borne out during December. I think looking forward, we should expect to see additional increases in the Fed's target interest rates and additional increases in market interest rates. But I think investors have learned by now that that's not really a bad thing for real estate investors, because it's in response to improvements in the macroeconomic situation. Improvements in the macroeconomic situation certainly are good things for REIT investors. And I think investors are also just sort of generally getting a better sense of what kind of capital structure do REITs use, and therefore what kind of impact should they expect an increase in interest rates to have on REIT investors. Because the truth is that REITs have brought down their use of leverage very, very strongly. They're not as sensitive to interest rate increases. Not only that, but most of their debt is fixed rate debt anyway. And in fact, investors have to keep in mind that to the extent that a REIT is holding debt on its balance sheet, when interest rate goes up and that's fixed rate debt, the value of that debt goes down, which is a good thing for REIT investors. So I think going forward there may be less concern about the effect of interest rates on REIT returns.
Well, thanks very much, Brad.
It's a pleasure.
And for more news and analysis on all things REIT, be sure to visit REIT.com.